You don't need as much as people often think, I need 50 or 100 grand to start in the stock market. That's not true. We have people that start with a fraction of that.
Investing then your gateway to the stock market, AB, how does one actually do that?
Somebody starting with $1,000 today, which is a thin amount of money, what would you do? And you go, well, the stock market's out of reach. No, it's not, because brokerage fees these days are so low. What's a brokerage fee? If you're someone that's new to the stock market or beginner, you're going to love this particular episode because Mitch and I are going to break down some of the key terms and some of the key steps for starting successfully.
The stock market, is it ever too late to get started?
Never, ever too late. If you had this conversation with somebody in April, they'd say, NASDAQ's at an all-time high. It's ready for a correction. It's now how many percent higher?
50 almost.
4 years ago, you could have bought Netflix for $180. What is it now? $12.50 a share? Buying an individual share can be quite challenging because you could buy the wrong share. And what I mean by that is a share that's not moving up. It could be a share that's moving down against you. You can either make money or you can make excuses. If you're someone that's new to the stock market or beginner, you're going to love this particular episode because Mitch and I are going to break down some of the key terms and some of the key steps for starting successfully. As always, don't just take notes. Make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
AB, I already love this episode, not because we're wearing matching pants on camera here, but we're going to go back to basics. And as seasoned pros in stock markets, sometimes when you go back to world-class basics, you can learn a lot more. So,
I'm glad we're not wearing matching shoes. I'm just looking at these. I feel like I was Patch Adams if I was wearing
I think they're the same brand, aren't they?
Quite possibly. Very nice. Very nice. Very understatedly sophisticated.
Indeed.
Don't let me derail you for your segue. Sorry,
That's
I couldn't help myself.
Back to business. So we're going to be targeting probably our more beginner investors out there. So people who maybe are yet to start in the stock market, because title of today's episode, the stock market, is it ever too late to get started?
Never, ever too late. Best time to start investing was yesterday. If not yesterday, then today.
Very nice.
I suggest it's never a bad time to start.
Well, let's dive into this. We might break down into a few key areas. So if we start with, say, broad markets in terms of where stock markets are, how they differ, some key terms, and also some key ways to get started into the stock market. So if you're absolutely fresh, you're green, you've got no idea, this is your one-stop shop and motivation to get started.
Great. Well, look, as an overarching qualifier for stock markets, I think they are an innate representation of human nature insofar as the optimism we all have towards the future. And if we're all more optimistic about our future than our past, that's why you see stock markets typically continue to move to new highs. And the naysayers out there, and trust me, there are plenty of those people that say, oh, you shouldn't do this or you mustn't do that. And that it's easy to say that when they're not doing anything themselves. The market's at an all-time high. The reason it's an all-time high is companies keep beating earnings, the future looks more optimistic than the past, deals keep driving things, and the market keeps moving higher. And if you had this conversation with somebody in April, they'd say, NASDAQ's at an all-time high, it's ready for a correction. It's now how many percent higher?
50 almost, I would say.
Almost 50% up since those naysayers were banging on about the end is nigh. You look at the news over the weekend, more and more mergers in the AI space and corporate deals which are driving it. And probably the most telling, and I think this is really, really important because it's so easy when you're stepping out of your comfort zone. If you're someone that's a brand new investor and you're about to step out of your comfort zone, we'll talk about the steps on how to do that in a few minutes time, and you're just about to hit the go button and then some talking head that's supposed to be a guru throws some negativity on it. You think, well, blimey, what am I missing here? And I'll give you a classic example. There's a guy that I've spoken alongside several times, a guy called Harry Dent, who is renowned for being a demographer and called a correction at one point in history. And I did an event with him. My daughter, Charlotte, would have been about 8 months old at the time. So
a while ago.
It's nearly 10 years ago, or around about 10, 11 years ago, 10 years ago probably in Vancouver. And we had a bet, and he said the Dow is going to be at 6,000, and I said it's going to be at 30,000. And so far we're looking at a Dow Jones which is sitting roughly
40,000 nearly.
40,000. And if you'd have listened to the advice of somebody like that and sat it out in the expectation that one day there could be a correction, you would have missed out on the opportunity to triple, if not quadruple, your wealth. So you have to be very, very careful who you listen to, particularly if it's coming from a negative slant. And that at the same time is not to be eyes closed to risk, as I'm sure we'll talk about. So optimism, very important. And I think that sets us up. The stock market is the perfect vehicle for that.
Absolutely. And it's your opportunity to do two things. Number one, own a slice of that business. When you buy a share, you are an owner of that business.
Correct.
Second to that is obviously make some great money. And that can be in the form either of capital growth or dividend income, or some more advanced option strategies maybe down the line. But we'll touch on what those basics look like. AB, question for you. For anyone listening to this, most likely here in Australia, where the majority of our listeners are from, probably the primary markets we're going to be looking at would be the ASX, which we can talk about what that is, and then the US stock markets. How do they differ? What are their names? What's the rundown?
Okay, so the ASX, the Aussie 200, the ASX 200, a lot of people a little older would have heard of the All Ordinaries Index, which is a very similar composition to the ASX 200. So the Australian stock market is probably one of the most concentrated in the world. So if we think about our banks, we have 4 banks. As a country, Australia is one that has very, very concentrated industries. We have 2 supermarkets, 1.5 airlines, probably 2 insurers, 4 banks, 3 resource companies.
It's
a very, very concentrated economy. And so if you look at our 4 banks plus our mining sector, which is obviously dominated by the likes of BHP and Rio, you could probably throw Fortescue in there too. That probably represents nearly 60% or so of the stock market. So you've got a very, very concentrated market. But more than the concentration, in my mind and the way I see things, and look, I'm very proud to live in Australia and to be an Australian citizen, we have quite an old school stock market where the businesses are not necessarily as innovative as some of the other places in the world that we'll get onto and talk about. So banks are banks. A resources sector, they dig things out of the ground or pump it out of the ground and sell it globally. But the cutting edge where the real growth in the world is the technology we just don't really have in Australia. We've got a couple of companies, you've got WiseTech, you've got Cochlear, CSL, Altasian, and that's really the extent of it in terms of major tech businesses, which relatively speaking are quite small compared to the rest of the world. So it is a little bit more of an old school type economy. The key thing with this, I'm not panning the Australian economy and the Australian stock market, because when you're starting out on this journey as an investor, the easiest step to take is to invest locally, to buy shares in companies that you use. So if you do your groceries at Woolies, buy some shares in Woolies. If you bank with Commonwealth, buy some shares in Commonwealth Bank. And that way, to use the Buffett sort of mindset, you're consuming that which you own.
Yeah, absolutely. And you're investing in stocks within your own backyard too, which makes it easier, I think, psychologically as well.
It's a lower barrier to entry for someone starting. And I guess the key to helping people get started in the market, we've helped tens of thousands of people do that, is to remove friction. And so investing in your own currency, in companies you know and understand, that's in a time zone that you're familiar with a broking account that lets you do it, that they're all simple steps for you to get started without friction. The flip side to that is that Australia is a very, very small part of the global economy. We're less than 1.5% of the global economy. Our market capitalization is about 1% of the global stock market. So we are a very, very, very small speck within the globe from an investing perspective. And when you then add into that the issues which our economy faces, and we won't turn this into an economic session, but Australia as an economy is struggling. I think we're teetering rather like New Zealand on this on the slide more closely towards a recession than boom. If you've got exposure to a market that's in a slower economy, your growth is likely to be slower as a consequence of that.
Gotcha.
Okay, so that will be the Australian market. Lowest barrier to entry, lowest level of resistance. Great place to start. I'm all about people getting started. But once you've then started, I guess pivoting into something that's a better quality opportunity would be something that makes a lot of sense if you're looking to make serious money.
So for anyone listening to this, if we look at, say, the US market, which is going to be our next talking point, they'll probably hear things like the NASDAQ or the S&P or the Dow. I mean, what does that all mean to someone starting out?
So the Dow Jones, that's the traditional stock market benchmark in the US, but the Dow Jones is only 30 companies, and they're typically older school companies. The S&P, the Standard & Poor's 500, the top 500 companies, or the NASDAQ, especially the top 100 companies, more orientated towards technology. There are some companies on the NASDAQ that aren't tech, Starbucks, Lululemon will be 2 examples of that. But there tends to be a lot more tech type businesses in what we call the NASDAQ. That's the name of that exchange. And I think from a growth perspective, these are companies that are driving the world right now. And if you think about companies like Google, Microsoft, Tesla, Netflix, Apple, Nvidia, It's really, really hard to look past those Meta. It's very, very hard to look past those companies as the drivers for where the future sits, as compared to something that's a utility company.
Yeah, it's funny you said before too. I think, as you say, the initial prompt for a lot of people is to consume or buy businesses that which they consume. I think with the element of globalization that we have now, probably a lot of the stuff that our listeners are consuming would be made by Apple, or they're watching Netflix, or they're using all of these US-based companies. So I think there's a huge growing area of interest for a lot of people over there.
Well, it is true. And I mean, we're talking now to people that potentially are beginners in the market to understand a bit more about it. And I guess being open-minded is extremely important. You think, there might be more risk with that, and sure, there are different factors. You're investing in a different currency, for example, or there might be companies that you're a little more distant from. I did a live talk a little while ago. It's actually to a bunch of retirees, a lot of people that manage their own super, so a very different audience to that which we're speaking specifically right now. And I asked them about the compositions of their portfolio, which was to a massive extent mainly Australian stocks. And I asked them why that was, and it was familiarity. And I said, but what's the objective of your fund? Is it to invest in things you're familiar with, or to optimize your return? Because they are not the same thing. And to give a more broad-based industry explanation to that, last year I managed to get a hold of a copy, don't ask me how, of a live portfolio from one of the larger industry super funds. And it was the current portfolio of their holdings.
Interesting.
And on a dollar-for-dollar basis, that particular fund had more money invested in Ansell, the company that makes condoms, rubber gloves, and other medical devices, that makes about $97 million a year in profit at the time. It had more money invested in Ansell than it did Apple.
Which is crazy.
Which to me defies belief, because you've got one of the world's largest companies, and it's not a speculative business. It is a cash machine these days in terms of the recurring income that sits there. Yet the predisposition to want to invest locally, even at a fund manager level, this is probably why more and more people should be managing their own super rather than trusting it to someone that wants to hold a tiny global player versus one of the world's largest company. Is why there's a ground shift. And so that conversation I had with that group of people saying you need to be open to growth. At the moment, the story for growth is the US tech sector.
Indeed. I think to a lot of beginners, it's confusing, right? Where do you start? It seems like such a big landscape, but it's actually not that hard. So
again, you go through, as you said, look at what you consume, and this is exactly what I did in that room. I said, how many of you own a computer? Who runs Microsoft on it? Who's got Apple? They all put their hand up because it's one or the other. Who's got an iPhone? Yeah, the hands went up. Anyone watch Netflix or Stan? Yeah, hands went up. Anyone that's looked up anything online recently, maybe Google or something, and their hands. I said, you are consuming these companies. You just don't necessarily realize it because it doesn't feel the same as going into a supermarket because it's online.
Yep. Switching gears a little bit now, we know what the stock market is and briefly how it works. Let's talk about now getting started, because this all sounds great, but for someone who's never done it before, they think, well, how do I even buy shares in the first place? I think it comes back to what we teach in the Wealth Playbook. Obviously, to invest, you need to have cash to do so. So budgeting and saving. Investing, then your gateway to the stock market, AB. How does one actually do that?
Look, firstly, you're right. You've got to have some capital to work with. So that involves budgeting in the first instance, and then that enables you to save. And it's very well articulated in our book. Getting your emergency fund set up and then starting to accumulate cash that you can use not as an emergency fund, but something you can then invest with is pivotal. So on the basis that you're starting to work with cash, you don't need as much as people often think, I need 50 or 100 grand to start in the stock market. That's not true. We have people that start with a fraction of that because you can continually add to your investment. So let's take a case study, a low account balance case study. And I've just been asked to do this for somebody in the US with a business over there. They said for somebody starting with $1,000 today, which is, a thin amount of money, what would you do? And you go, well, the stock market's out of reach. No, it's not, because brokerage fees these days are so low that there's no barrier to entry in terms of a brokerage fee. Now, let's just backpedal. What's a brokerage fee? To buy and sell shares, you need to have a broking account. It's kind of like a bank account, but lets you trade shares rather than just cash. And that will enable you to be able to buy or sell the shares that you have. Typically, they come with charting and news flow and the ability to produce a tax report and all of that different back-end infrastructure.
So like NAB Trade, ComSec, Interactive Brokers, these are probably companies people may have heard of.
Yeah, and look, there are a plethora of them out there. Some are better than others. Some are very focused on the domestic market. So, for example, if you look at the likes of ComSec, which is the biggest broker in Australia, that's part of the Commonwealth Bank, but it's designed to trade Australian stocks. And there's a much bigger world out there than just simply trading Australian stocks. So with our brokerage platform, for example, we have access to 127 markets around the world. Our brokerage fees are also pretty damn thin and make it cost competitive. So you need a broking account to be able to buy and sell shares. When you buy shares, you pay a transaction fee, which is called your brokerage rate. So with $1,000, what would I be doing if I was someone that was just getting started today? Buying an individual share can be quite challenging because you could buy the wrong share. And what I mean by that is a share that's not moving up. It could be a share that's moving down against you. Obviously, that $1,000 then becomes $950 or whatever it may be as the trade drifts away from you. You're very concentrated. So these days, one of the big growth areas in markets is something called exchange traded funds, ETFs for short. And I know this is an industry that loves having abbreviations and acronyms for stuff. ETFs is an exchange traded fund. And effectively, what that is the ability to buy one type of investment that then invests in a whole myriad of different things. So you could invest in an index tracker, which just simply tracks the index. And we've spoken of the NASDAQ or the S&P or the Dow Jones.
All of them in the one, right?
Or the ASX 200. So instead of having to buy a whole bunch of shares, you buy one instrument that invests in those shares. So it makes it much easier, lower transaction fee, better diversification, and gives you a foot in the door. And again, this is all about removing friction, foot in the door, get you started nice and easily. So with $1,000, you could buy units in or shares in an index tracker. And then over time, as you accumulate more savings and you've got your budget working, you might become a regular saver where every month you might be able to save an additional $500. And maybe your game plan is, okay, every quarter, when I've got $1,500, I'm going to buy another $1,500 of that exchange traded fund, or maybe a different one to give you some diversification in what you're doing. So you can get started with a very, very small amount of money. The tools are all there to be able to assist you in doing that. And mark my words, just get started.
That's right.
Yeah, what, 4 years ago, you could have bought Netflix for $180. What is it now, $12.50 a share?
Yep. I mean, a lot of people say I don't feel ready, but as they say, ready's not a feeling, it's a decision, right?
I love that. Great quote. Can't remember where you got that one from, but it's a good one. And it is. It's about being unemotional. It's making a commitment.
Yep. As you say, I think getting started, my advice would be the exact same to beginners, is just buy an index fund and add to it as regularly as you possibly can. 100%. Whether it be weekly, monthly, quarterly. Don't worry about timing the market. Every time you get paid or whatever it is, just stick some cash in there and let it sit for as long as you can.
Exactly right. Trying to time the market, there's another level of sophistication in there where you need more training, the ability to read the tape, the charts, all those sorts of things. Yeah, I've got a birthday account for my household, and every time it's someone's birthday, I buy a slab of investment in that particular account. And I don't sort of, I'll wait till the market's pulled back or I'll wait for this. I just get it in because on the grind, I'd rather have that money working than waiting for the perfect storm. The perfect storm simply doesn't come along. And it's so interesting. It's so easy to find reasons not to do something, and yet you want more. So you've just got to blow through those excuses. They're not reasons for we'll wait for this or this could happen. There's always going to be something that could happen. Yep. You just got to get started, because then you start to build momentum. You can either make money or you can make excuses.
Oh, very nice. I like that. Okay, moving forward now. Once our listeners here have got into the stock market, there can be a lot of confusing terms which you then have to become equipped with. So different element to the podcast. We haven't prepared for this, but I'm going to throw it at you. I'm going to give you some terms on rapid fire. You then need to define them back for our listeners.
Jeez,
how's that sound?
Yeah, I'm sweating in anticipation.
No prep work here, but they should be fairly basic for you. So we'll go through some common terms that beginners may be misunderstanding in their initial stages. Dividends.
Okay. So a dividend is an amount of money that's paid by the company to its shareholders. And it's, I guess, if you think about it, if you own a share in a company, you own a little slither of that business belongs to you. And depending on how the year has been, profitability-wise, and whether the company, for example, might have big reinvestment plans, is building a new oil refinery or whatever it may be, the profit that's left over, it then will typically distribute to its shareholders by way of saying, thank you for investing with us, and here is the cream on the cake for you, your slice of the profit. That effectively is what a dividend is. And there are some companies that pay dividends, others that don't. Typically, dividends, if you look in Australia, for example, the banks are renowned for being regular and consistent dividend payers, and the tax is paid on it. So it can be quite tax effective through a franking system in Australia. So as a shareholder, you can receive this almost tax-free or certainly lower tax income. Very, very appealing. Other companies choose not to pay a dividend. Instead, they feel that they'd be better off retaining the money to reinvest in the business. And there are plenty of examples, particularly in the tech sector. As I mentioned before, Netflix has never paid a dividend or barely paid a dividend. And it's added a six-fold increase to shareholder wealth over the last couple of years. So that's a dividend. It's your share of the profit. It's a great little bonus. Australia, you typically get one twice a year. In the US, you might get one quarterly.
Here's a question a lot of beginners get when they first buy shares. Dividend reinvestment plan versus taking it as cash. What does it mean? How are they different?
Well, I think dividend reinvestment plans are very, very appealing for a number of reasons. One, they can be quite tax efficient. Number two, if you take the money out, and it's rather like if you earned interest on a savings account, not that you get much interest on cash anyway, but let's say you did, and you just take that interest out every time you get paid it and go and spend it, you're not growing your wealth. Effectively, what you put in is what you're going to pull out. You're just getting the extra cash out of it. You're better off if you can do it just to let it run and accumulate and accumulate and accumulate. And I was just having a yak on the weekend. I was doing some camp drafting of all things with my daughter, and I was chatting with one of the fellas there, 70-year-old guy, and he asked me what I did, and we're chatting away. He said, "What do you reckon about BHP?" He said, "I've owned them forever. I've always had the dividend reinvestment plan." I said, "That's probably one of the smartest things you've done." I said, "How many shares did you buy initially?" And he told me. I said, "How many have you got now?" So now he's got this big slab of shares, because instead of taking 4 or 5% dividend each year, he's just let it roll and accumulate and grow and spin the flywheel even more. So I think if you can use a dividend reinvestment plan, it's tax effective. What it does do on the other side of the coin is it can mean that you've got a bit of an imbalanced portfolio where you have quite a lot of shares in maybe one or two companies, and a lot fewer or smaller exposure to others. But that's a more advanced problem to have to deal with than someone that's getting started.
So you're taking the cash, using that cash to automatically buy shares without even really thinking about it, versus taking out as cash and maybe withdrawing it.
As soon as cash is in your hand, you're going to find a better use for it than what you should be doing. That's for sure. We all know that.
All right, next one. Market cap.
Yeah. Okay, so market cap doesn't mean a lid on the market. Market cap is an abbreviation, and it's called market capitalization. And effectively, what that is how much is the company worth? So it's the number of shares that are on issue multiplied by the share price. So if you have 1,000 shares on issue and the share price is $10, the market capitalization of that company is $10,000. Now, obviously, companies that are listed have values in the billions and billions of dollars, but it's just the overall value of the company. And look, it can be a little bit misleading, because you'll see one day, the biggest company in the world can change by market cap, and it might be that there's been an announcement that's bumped up their share price. To all intents and purposes, it's the same business as it was yesterday. It's just the fluctuation in value of the shares.
Okay, speaking of which, what about an earnings report? What does that mean?
Okay, so it's when the companies sit down or stand up, and they'll come out and give you guidance on what the earnings of the business, what the performance of the business has been like over that time frame. In Australia, they're typically every 6 months, so we have a full year and then an interim 6 monthly. In the US, they typically are quarterly, and I'm a big fan of quarterly because it just keeps you more in tune with what's going on in the business. It's more current than anything else. It's kind of like if you're watching a game of football, would you want to see the score at halftime and in the final, or would you like to see the live score and you can follow the game more closely, of course. And so they'll come out and talk about, okay, these are the major things that have happened. This is what, for example, our sales have been, or if you're a car company, how many cars you've sold, or if you're a subscription business like Netflix, how many subscribers you've added, or if you're in the sales business, what your gross sales have been over that period of time, what your profitability looks like, whether you've got any big investment plans, for example, and then what the earnings per share crucially look like. So as a business, our earnings are growing per share, which is great for you as a shareholder, and typically would drive the share price up. Or times are really tough, we're really struggling, we've got all these factors, labor costs, cost of input is there, it's a weaker market, so we can't push our price up, so our earnings are a bit lower because of it. So it gives you a good insight. It can be very, very confusing for new people to the market to go through an earnings report, because what's important and what's not can be quite tricky to discern.
Last but not least, price to earnings ratio, PE.
Okay, so the PE ratio is a bastion of a lot of old school investors, and I don't besmirch it as a ratio by saying that. Effectively, it's the price of the shares divided by the earnings per share, and it gives you a valuation basis. So let's say the shares are $100 and the earnings are $5 a share over that time frame. 100 divided by 5 is 20. So the PE ratio is 20 times earnings. In other words, you've got to hold the shares for 20 earnings cycles in order to recover the price of the share to buy them. So it gives you a valuation, and it helps you understand whether a share is relatively expensive or it's well priced. So, typically we see a range in the market historically where markets are relatively cheap to buy or when they're relatively expensive and probably are more of a sell phase. Now, the challenge with PE is price. Well, that's easy to see. You can look at that online. You can see it real time where it's at. What, however, do you use for earnings? Do you use historical earnings, in which case you're buying a share today based on the rear view mirror, not the most reliable, or do you use a forecast / guess of what it might do going forward, in which case you're basing half your analysis on the punt of whether the analyst is going to be right. So it can be a little bit tricky in that regard, hence why I say it's a little bit of an antiquated approach.
Nice one. That was the rapid fire done. I think you did pretty well there.
Whew. Did I pass?
Yeah, I think you did.
Good stuff.
Yeah. Last but not least, overall for our episode here today, AB, this has been a great insight for a lot of beginners, and I think we've covered off key terms, getting started, and what everything means. Would you suggest any additional resources for people listening to this to help them get started?
Look, I think mentally there's a decision to start. That's a really important one that you have to arrive at, and you can find it's easier to do nothing than it is to do something. Okay, and so I acknowledge and understand that. Stepping out of your comfort zone and just giving it a go. Look, get a broking account open, go buy an index tracker. That's your starting point, and you can build momentum. From that point onwards, start to then also look at and invest in your education, because the more skilled you can get at this, the better quality decisions you're going to make. Ideally, you're going to have better levels of risk management. The investment choices you'll make are better. The challenge is if you just go down the education pathway without starting, you're going to become someone that knows everything but does nothing. Professional student. You don't want to be in that situation. You've got to get both under control. So to an extent, dip a toe, small amount of money, get the motivation and the momentum there, and that's great. You've actually got a foot in the water. You're starting the game, then get educated, and then once your confidence starts to grow, keep adding more and more to this, and don't look back.
Very nice. Thank you very much, AB.
My absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.